Hello everyone, Aaron Ninness, Denver, Colorado, your mortgage professional, and another episode of How Much Can I Afford? Today's topic, mortgage insurance. Mortgage insurance is basically foreclosure insurance. If you are putting down less than 20% on a home, you have to have mortgage insurance in most cases. Now, mortgage insurance is one of the biggest and most complex portions of the mortgage payment. And I'll tell you why. There are different names for mortgage insurance. There's also different types of mortgage insurance. And then how it's collected is different depending on the loan type. This can be as simple as an FHA loan that has upfront mortgage insurance. Now, for example, they charge 1.75% of whatever you borrow. So if you're borrowing $100,000, they're going to add $1,750 to your loan amount. You don't have to bring it to closing, but you will finance it into the loan. If you're a veteran, it could come to you as a funding fee. They charge that up front as well. That can be added to the loan as well. If you have 10% or more service-connected disability, chances are you do not have to pay the funding fee. The first time you use your VA benefit to buy a home, it's 2.15%, or $2,150 for every $100,000 you borrow. Every subsequent use of your VA benefit, 3.3% or $3,300 per $100,000. That's added on. But here's some of the differences. FHA, for example, has also monthly mortgage insurance. So you pay upfront at 1.75, but at the time this is being recorded in August of 2017, it's 0.85 with 3.5% down payment on an FHA. Meaning for every $100,000 you borrow upfront, they're going to charge you every year $850 per $100,000. That $850 is divided by 12 and broken up into a monthly increment. Now, do the math real quick in your head. If you're doing this on, let's say, $300,000, $850 times 3 is going to be somewhere in the range of just over $2,500. Well, that's over $200 a month in mortgage insurance. And what do they call it? MIP, mortgage insurance premiums. Where conventional loans call their monthly mortgage insurance private mortgage insurance. Different name, but almost the same thing. The difference is that FHA has monthly mortgage insurance that's very set. It's the same for everyone. Same with the USDA. And VA loans don't have monthly mortgage insurance. Conventional, it is a different rate based on how much you're putting down and what your credit score is. It's a simple grid that just shows right to left. If you put down more, the rate goes down. If you have better credit, the rate goes down. But where it gets even more complex than that is how you pay it. You can pay it monthly, just like you can on an FHA. But you can also pay it as a one-time lump sum. Pay it all up front at closing and then never deal with that payment again. You can take it as lender-paid mortgage insurance, where a lender might offer you a slightly higher interest rate, but they pay the mortgage insurance premium for you in full. There's also split. A portion's paid up front and a portion paid monthly. There are tons of ways to do your mortgage insurance. And there's tons of ways to get that rate lower and kind of some cool things that you could do to keep the payment down low. But that is in a nutshell what mortgage insurance is. Now, why is it used? Again, it's just foreclosure insurance. If for some reason you don't make your payment and the house is sold, the losses that are incurred to the lender are paid by that mortgage insurance policy. They don't pay 100% of it unless it is like an FHA, or like a VA loan where it's guaranteed, or a USDA loan where it's guaranteed. Those are guaranteeing our losses. But FHA and conventional are truly insured. So they're only insuring a portion of what the potential loss is. And that's kind of the differences between them. Hopefully, you will have a better understanding of what mortgage insurance is and what some of the options are, but this obviously is not going to cover every scenario out there. So if you need some help figuring out what the best options are for you, give us a call, shoot me an email, or I'd be happy to go through your personal scenario. Otherwise, keep learning, keep watching the episodes. Make sure you subscribe, give me a like if you can, and we'll see you on another episode.